So I just want to thank everybody for joining us for the product tanker panel. Energy, oil products is LNG, LPG is in the mainstream right now of everybody's attention, especially given the geopolitical tensions at the moment. We have a terrific panel with us. I will let Omar Nokta from Clarksons Platou moderate, and thank you, Omar. Thank you, Tony, Jacob, Mikael, Carlos, and James. And Omar, the floor is yours. Again, thank you very, very much.
Great. Yeah, thank you, Nicholas. Happy to be moderating this panel. Clearly, as you mentioned, the product tankers, especially here over the past several weeks and months, have become very topical, and we've seen earnings flying here through the roof the past 4 weeks or so. So I think a lot of things to discuss, and we've got the who's who of product tanker companies on this panel. I figure what I would like to do is maybe, since we have some time, start off, open the discussion up with a little bit of strategy, and then get into some of the market fundamentals, and then maybe finalize with a bit of uses of capital. And so maybe first off, what I would like the horn here, and then just ask each panelist to just discuss what it is that they're doing at their company strategically that is unique to your own specific company. And maybe I'll just start off. I'll go from my screen top left to bottom right, and Tony from Ardmore, if you could kick off, please do.
Yep. Always good questions, Omar. Thank you. Yeah, I would say what we're doing maybe a bit differently is our emphasis on chemicals, but essentially non-CPP cargoes. We've had a significant component of our fleet in chemical tankers so at the moment, 25% of our fleet, maybe 30% of our cargoes are non-CPP. We also tend to focus on smaller size ships, and we're in an interesting market environment that maybe we can talk about later, where it seems both in dry bulk and tankers at the moment, the smaller the ship, the more they make.
Got it. Thanks, Tony. James, I'll go to you for Scorpio.
All right, thanks, Omar. So I think for us, we're focused on executing operationally, improving the balance sheet, and we're recently evaluating sustainable solutions to minimize our impact on the environment with our carbon capture announcement. And after several challenging quarters, we're going to pay off more than 500 million of debt in the first half of this year, which definitely feels good. And if the market stays where it is, we'll have, could have 400 to 500 million of cash on the balance sheet. So we're really excited about the position we're in after what has been a challenging 6 quarters.
Yeah, thanks, James. Carlos, for DOMICO.
Yeah, for us, we have continued disposing of some of our older vessels after ordering several new vessels. So we are glad now we have over 80% of our fleet, which is eco. And I would like to stress, which is something which is quite different from what we usually do, since we have a very positive outlook for the market. We had before the war already a very positive outlook for the second half of the year. Whenever we did take coverage, we took a rather short coverage, around 6 months. So we have a lot of exposure in the second half of the year. And in the last quarter of the year, we are around 90% exposed to the spot market. And in 2023, we are 95% exposed to the spot market. So we are looking forward to benefit from the strong markets going forward.
Very good. Mikael.
Yeah, thank you, Omar. Yeah, so for us, there's been a lot of focus actually on modernizing the fleet. So our view has been that looking at the shipyards, the new build prices have gone through the roof, availability is very low, plus there's no real incentive or interest in building new tankers of old design. So our view has been that the modern tonnage is where you want to be. So we've added 44 ships over the last 3 months to the fleet. So that in itself, has been a strategy as such. And I think what has made that possible as well is our ability to get attractive finance. So, we finance part of that acquisition with 100% finance at 200 basis points, just to give one example. So I think that has kind of been our focus area, is really to make sure that we, prior to the uptick that Carlos mentioned, which we also believe in, that we were sitting back with a modern fleet at a time where the regulatory requirements are also going to tighten in general. So so that's been the focus area for us.
Thanks, Michael. And Jacob, for TORM.
Yeah, thanks, Omar. Well, I think in our case, it's the integrated platform. We got all activities in-house, and as the industry is meeting higher regulatory needs, and also obviously that we are all focused on lowering our CO2 footprint, that the integrated platform is offering a unique opportunity to embrace that and to deliver on that also to our customers.
Excellent. Well, thanks, guys, for that sort of quick strategic introduction for each of your companies. And I think probably the most important topic is clearly what's going on at the moment in the product market, or maybe that's not the most important, but it's very relevant, at least given the overall backdrop. So I guess my first question, maybe Tony, just starting with you. What are you seeing right now in the product market? What has transpired here over the past month that's gotten earnings to where they are today?
Yeah, it took, for the first week or so, there wasn't really much of a reaction, but then it really began to build. And I think it's simply just disruption of trade flows. Really, in the end, it's usually driven by price differentials. We've seen fundamentally, we've seen, a real swell now of products, moving from the east to the west, refined product, diesel, mostly moving from the U.S. Gulf into Europe, et cetera. So, you're just seeing a disruption of trade. On the chemical side, it's probably in a sense even more disruptive. We're seeing very long haul trades, probably based on price differentials of commodities from the east into Europe and the west. And in addition, things that aren't, not exactly chemical cargoes, but liquid fertilizer, which is now, Europe was relying very heavily on UAN liquid fertilizer from Ukraine and Russia. Now, we're shipping, relatively small lots at very, very high, high rates from, for example, the Caribbean to Europe.
Okay, thanks, Tony. And then maybe Michael, anything to add on that and what's taken the market here? Given we all started maybe about a month ago, rates across the board were maybe in the single digits, if I recall. And now when we look on our screens, we see LR2s, LR1s, MRs, handies, as Tony's mentioning, everything's in the 20s plus. And if you have an eco or a scrubber, we're talking maybe 30. Those are obviously very strong rates that we haven't seen for nearly 2 years. What else do you think is behind this move? Tony mentioned disruption. What else do you think?
Well, I mean, I think actually that this ties in pretty well with the last panel discussion we had, I think even on the Capital Link forum, which is that we all saw that the world had brought itself in a bit of a complex situation by having drawn down inventories as we had. So I think we even mentioned in that discussion that whenever something would happen of any element of geopolitical character, that could ignite the market, because basically what typically happens is people look for the finished products. So I think in what Tony said before, which we obviously concur to, is that you've seen movement from east to west to cover from shortfall in Russian exports. But in addition to that, you're also seeing a lot of uncertainty of ships. So we've seen exactly that play out that we envisage, all of us here, I think, is that ships are uncertain to where they go. So that means not only are you getting longer ton mile, longer distances, you're also creating uncertainty for when ships are open again, which automatically will then put pressure on the market because it's lower supply. So, this whole just-in-time operation that we're seeing now, and which we think will continue, is kind of been ignited by the Russia-Ukraine war, but it's also very much reflected by the low inventory situation we have been in, and the fact that we are all here transporting refined products, which is a final product as opposed to crude oil that still needs to go through a refinery, etc., before it materializes. So I think that's part of the important story behind this as well.
Thanks, Michael. And maybe Jacob, Michael brought up an interesting point about vessels being fixed with destinations still TBD. Is that something that you're seeing as well at TORM, and is this becoming more and more prevalent here over the, as a result of the disruption between Ukraine and
Clearly, you are in an environment with very volatile underlying commodity prices, and there, obviously, our customers very often can optimize their earning underlying by having multiple destinations, i.e., that depending on the day almost, it will be beneficial for customers to have trade routes that we didn't even anticipate, let's say, a month ago. So clearly, and maybe just supporting Tony and Michael. I think to your point, Omar, I think one thing is what we've seen sort of play out over the last 4 or 5 weeks. But I think what underlying is important to think about is that these political currents, i.e., less reliance on Russian energy, and that of course goes through all energy specs, including diesel. That is not a short-term thing in our opinion. That is something that will go on for longer. And the extreme sort of reliance on that you can have just-in-time deliveries, i.e., to have strategically inventories also on refined products very low. I think those two themes will not be the same. Also, as we sort of hopefully will see an end to the atrocities in Ukraine. So that means that what we're seeing short term is actually good also for product tankers in the long term. Both, I think the political sort of reliance on that you can have inventories very, very low. I really cannot see that's a good choice going forward. And the other is that we will, over time, be working towards having less dependency on Russian oil and energy at large. Of course, the US could, in essence, do the cut sort of in one go. In Europe, it's taking longer, but it is a factor that will continue, and that is good for the ton mile. That's good for the product tanker industry, also medium term.
Thanks, Jacob. Maybe Carlos, just on Jacob's, one of the points he was making was the evolving trade patterns and how they're shifting, and they potentially may they've just started as a result of the disruption, but Jacob's mentioning how these are going to be longer lasting. Just out of curiosity, Carlos, for as you operate your vessels, any new trade patterns that you have seen develop here over the past month that are different than what you've been used to seeing?
Yeah, Omar, no, this is an important point, and we are only just starting to see this, but I think it's with these trends that we have seen over the last few weeks are likely to strengthen, and irrespective of an end to the war, which we of course hope will come as soon as possible, because of private sanctions, as Jacob was correctly pointing out, which means that even if official sanctions were removed, it is likely that many private companies would prefer not to continue buying Russian oil. So, however, Russian oil, will decline. Experts, especially if the war were to continue, are likely to decline. And on the refined product space, we are talking maybe of 1 million barrels less in exports. But a lot of the oil will find buyers, especially the crude oil. It will find buyers most likely in China and in India. And in India, we already saw quite a big increase in imports of crude oil. And in the last month, they imported as much as in 6 months last year from Russia. China is already a big importer of Russian oil, but it's likely to import much more going forward, benefiting from quite a big discount on their purchases. The Urals are being sold at a discount of $25 to $30 per barrel relative to Brent. So the refining margins in these countries are likely to be extremely attractive, and they are likely to become very important exporters of refined products to the rest of the world. That is a trend that we were already seeing before the war, because that's where the new refinery capacity is being added, mostly in Asia and in the Middle East. But what is happening now is exacerbating this trend, and And so it's going to be very beneficial to ton miles because a lot of refined products, which used to be exported from Russia, in particular diesel, which Europe is very dependent on very short distances, are now going to be coming from Asia and the Middle East. And we are likely to see Russia exporting more refined products to Latin America. So there are definitely going to be new routes opening up, which would be very beneficial from a ton mile perspective for the product tanker side.
Thanks, Carlos. Yeah, it seems like that's clearly the new trade patterns and new longer trades across the across the different vessel classes is on the come here. James, just Carlos mentioned refining margins, and I think it's at least worth mentioning that. I know, James, you spent a lot of time looking at the refining market. We've seen refining margins and crack spreads globally at fairly high levels for the past several months, and then they've only just gotten even stronger here recently. What do you think is driving that? What is driving those higher crack spreads? And then also, what are refineries now doing as a result of those higher profits?
Thanks, Omar. Yeah, margins have been really impressive as of late. I think the U.S. Gulf complex margins are the highest they've been in the last 10 years. It's demand. I think what we've seen, even pre-Russia-Ukraine conflict, is the market was going to be tight on a crude level, on a gasoline, and on a diesel level. And as Carlos mentioned, Russia-Ukraine situation has really exacerbated this. So from the refining side, we've seen closures, right? We've seen dislocations between the types of crudes that they're used to running, and demand has remained the same. We've also seen a period of refinery maintenance here where everybody's trying to scramble to finish maintenance and increase utilization to maximize output in response to these cracks. I think it's been really surprising to see how high output has been with higher gas prices, natural gas prices that are used in hydrocracking units. But I think at the end of the day, margins will respond to demand. And I think we've got a lot of dislocated product here, probably the tightest distillate market we've ever seen coming in the next quarter or two. And refiners have not been able to build inventories. I mean, if you look at the diesel inventories over the last several months, refiners increase utilization and they can't build. So I think it's going to be certainly encouraging for us over the next few quarters here as demand comes back, and you need to basically fill markets with either gasoline or diesel, and even naphtha and potentially jet by the end of the year.
Yeah, so it's good to see that the demand is clear, strong, and there's always anytime it's retreating today, but anytime oil is very high, people start to wonder the impact on demand. But thus far, the refining margins are telling us that demand is there.
Yeah, it's funny. Oil's retreating today based on a ceasefire, and I really hope for everybody that conflict ends. But it doesn't change how we were looking at the space at the start of the year, which is oil is probably going to be at a 2 million barrel a day deficit, right? Gasoline probably 1 million in the peak months, and you're probably looking at 500,000 barrel of diesel deficit that you need to find an answer to. And the only way to do that is to raise runs.
Yeah, I guess as Michael mentioned in his the earlier comments, the setup has been there since maybe the last panel discussion at Capital Link, and maybe this war has maybe brought that to the forefront, or maybe illuminated the situation, even though it's been pretty obvious. It's made it even more obvious. Tony, I wanted to ask you about this. We've seen here over the past 5-6 weeks, we've been talking about this strong product, or you mentioned, I guess it's maybe been only 3 or 4 weeks, but in general, the product tanker rates have been through the roof relative to what we've been used to seeing. VLCCs, Suezmaxes, Aframaxes on the crude side, we saw rates really surge immediately after the invasion, and then they basically have given all those gains back for the most part. Product took a little longer to develop, and now product is holding these gains. When we look today, rates are still flat at these high levels. What do you think is different? What's making the product market hold on to its gains, whereas the crude is giving it back? Any color you can give us on that, you think?
Yeah, I think probably going into this, there was more surplus in the crude sector. First of all, I think the product market was already fairly tight. I think, as Mikael was pointing out earlier, we're really dealing with a demand pull. And what James is saying about refineries, there's a lot of demand. We've gone from sort of just in time to just in case to I got to get some barrels, right? And so, we like a couple weeks ago, we saw panic buying in Latin America. Just basically, grabbing any distillate that was available in the U.S. Gulf. So I think you've got this kind of situation of disruption, dislocation, that's and restocking maybe in a little bit in a funny way, that's just driving a lot of demand activity. And as Jakob mentioned, some very strange routes popping up as well, right? So I think that's creating a just a fundamental increase in demand, and that's not happening on the crude side. Now, one thing that is interesting is that obviously every crude tanker that's delivering from a yard in North Asia, if they're at all able to, is going to do gas oil, or even jet, on its maiden voyage, and maybe a couple after that. What's interesting is that they probably can't push any more into it, otherwise they would be right now. But if something happens on the crude side and that market goes up and they start pulling out of the product trade, that could really turbocharge the product market. So I think that's something to kind of keep in mind. But it just feels like we're just in this very disrupted phase. And Jakob mentioned that the distaste for Russian oil, if you want to call it that, is in Europe for sure, which is, despite my accent, that's where I sit and live, is pretty intense. And we'll find a way to wean ourselves at least off of the reliance, and that's just going to result in more ton miles, and that's going to be sustained almost no matter what happens with the conflict.
Thanks, Tony. Potentially more ton miles and maybe just more tons in general. Maybe Jakob, just I guess on the last question I was asking Tony, just about the crude versus product. Historically, I've followed shipping for 18 years, and they tended to be tied at the hip. Crude and product move up and down together. What we've seen maybe since the pandemic is they've kind of gone their separate ways, where product has generally outperformed, and now what we're seeing is, even as things have improved, product is outperforming. Do you think that there's this? Are we now starting to maybe create a detachment between both segments? Or are they still very much connected? How would you characterize the crude versus product at this point?
I think you're pointing to the right dilemma, Omar. When we've been modeling so far, we've also been sort of actually holding ourselves back a little and saying, listen, we can't get too far off the chart on the product side without also having the peers in the crude space also having an uplift in rates. I would say that with the current sort of regrouping of the whole energy complex, I think the jury is a little out whether you really need to have the same dislocation on the crude side and therefore ton mile as you need on the product side. I tend to believe that what we're seeing could be a trend. However, historically, as you point to, if you go back in history, is for very short periods that they are not very, very closely attached. But I think it's a little early, and I'm not following the crude market specifically on a day-to-day basis, the same as I do on product. But my instinct is that there are still challenges in the crude segment. And so if I look in the sort of immediate sort of future, I believe that products will be healthy, and the jury's out on when it is that actually crude tankers will benefit. So a bit of a political answer. I'll leave my bets open in the longer run. I think in the short end, products is a much better place with the current sort of dislocation that we've got. That is clearly beneficial, as we all sort of been around here, for product tankers, and less so for crude, up until the day when OPEC Plus decides to sort of bring on more barrels as substitution for Russian barrels out of the Middle East. That could be a game changer for the market.
Got it. Thanks, Jakob. That's a good answer. Generally, yeah, it's the one that continues to evolve to see how that works out. Maybe Carlos, just wanted to ask you on the inventory situation. We've talked about that and how they've been very low, and there's been the just in time, just in case approach. What are you looking for to see? You know, when will we start to actually build inventories again? Any things that you're keeping your eyes on that will suggest or that will start to indicate to you that okay, now it's time, the world's ready to start building stockpiles again?
Yeah, Omar, I mean, this is a quite an important question also, and the market is undersupplied. I mean, and it is likely to be undersupplied for at least the end of the year. So unfortunately, what I see is very dangerous continuing draws in inventories going forward, which we will have to deal with. But this will eventually turn because industries, the economy cannot operate with such low inventories. It is not safe to do so. And when it does turn, it is going to be extremely positive for us. It will turn when the supply catches up with demand. I mean, demand, we either need demand to decline or to grow very slowly, or we need supply to increase very fast, right? And on the demand side, even after the start of the war and the downward revisions to the forecast to the increase in demand, we are still, the International Energy Agency still expects demand to increase by around 2 million barrels per day this year. So it's still quite a fast growth in demand. So that's not what is going to be rebalancing the market. On the supply side, the expectations are now of 1.6 million barrels per day increase this year, or at least between March and September this year from OPEC, and a 1.7 million barrels per day increase from non-OPEC sources. And so that would equate to a 3.3 million barrels increase, which would help to alleviate this undersupply situation, but it's probably not going to be enough. We will need, hopefully, you know, an agreement can be reached, which is beneficial for everyone with Iran. Iran used to be a big exporter of refined products, of oil generally, and of 2.5 million barrels per day. And it's currently only exporting around 600,000 barrels per day. So a lot more oil can come, crude oil in particular, can come from Iran. Potentially some more crude oil can come from Venezuela. There are discussions ongoing there too, although there are years of underinvestment in the oil exploration industry there. So it is unlikely that Venezuela can be a big contributor, even if an agreement is reached. And then, of course, you have the shale oil, which in theory has quite a quick response time, 6 months, 8 months from drilling to production. But there are challenges, of course. There are the listed companies which claim to be prioritizing dividend distributions and rather than investments. But it's also true that the private companies today account for 50% of the rigs. Their share of the rigs has increased quite a bit since COVID, from 30% to 50%. So they will be driving the increase in production. I believe we could be positively surprised there. Of course, you know, there are all sorts of bottlenecks that could arise in the eventually in the capacity to transport also the oil to the terminals for it to be refined and exported. And there are also other bottlenecks in the production. Today I was reading about the fact that there is potentially a bottleneck in the sands needed for the drilling. But I think the price, you know, very high price we are currently experiencing for oil will create a big incentive for these bottlenecks to be solved quite fast. And I'm quite positive that we are going to be, you know, surprised by a bigger increase than currently forecasted from the U.S. shale oil.
All right, yeah, we'll see. That seems to be where that could be the biggest potential of new capacity, new barrels coming to the global market. James, on the refining side, one of the biggest themes has been over the past maybe 10, 12 years has been this increasing shift of older, simple refineries being shut down and being replaced with either, obviously more modern, complex ones. And at the end of the day, the production is farther and farther away from the consuming side. And that's created, whether it's new trade patterns or triangulation opportunities. How do you think, have you guys done any work to think about what do the next, say, 10 years potentially look like on that end? And that's maybe too long, but in general, when we think about an energy upcycle that's potentially here increasingly being anticipated, do you still expect that trend to continue where refineries are being shut down and replaced with longer ton miles from newer places?
It's funny because it kind of relates to the correlation between crude and products, right? So if we go back, to the early 2000s, you had a product tanker market or a crude oil market that would ship, the crude to the refinery, and then whatever was produced would be consumed domestically, and whatever was left over would go on a product tanker. And that really changed quite a bit with shale and the Middle East refining capacity expansions. I think we've seen probably about 2 million barrels a day closures. We highlight the ones in Australia because they're the most significant. It's the easiest for people to understand, but that has had a material impact. And also some of the closures in Europe and even Canada, because they take away supply from regional markets. So it's funny, in 2021, ton mile demand was actually higher than pre-COVID levels, which I think was just missed because volumes were lower. But it's a trend I do see continuing. I mean, on one hand, you've got older, less efficient refineries. They're not as complex, and they require hundreds of $1 million of maintenance capex to keep them running. And what we have seen is basically price competitiveness from Middle Eastern refineries, US refineries, and Asian refineries, where it just makes sense to close the refinery and use it as an import terminal. I think the next stage of what happens with refining capacity is really going to be what's your cost of carbon, right, in these different regions. So if you look at European refining capacity, or even in the US on the West Coast, they have the highest taxes, right? So you've seen, in the United States, the highest gasoline prices in California due to tax. And so if you think about that from a refining standpoint, what does your cost of carbon do to your margins? And that's probably the next 10 years as we kind of go through some of these environmental changes. But if you think about what's coming online, the last refinery in the Middle East, or two, the one in Saudi Arabia that comes online, Jazan, this year, that was supposed to begin construction in 2013. So you haven't seen outside of Asia a lot of people come out and say, look, I'm going to build, this new refinery. I mean, there's Dangote in West Africa, there's Al Zour in Kuwait, Jazan in Saudi Arabia, and then a few in Asia. But aside from that, these projects were planned, 5, 6, 7 years ago. So it's actually interesting. I don't think there's a desire to add more capacity, which will mean we'll probably see, more of this, capacity closer to the wellhead supplying the market.
Interesting. Thanks, James, for that. And maybe I'll switch gears a little bit and talk a bit more about the maybe the S&P market. And Mikael, HAFNI has been fairly active here over the past several months. Obviously, everyone's active, but in general, maybe just want to get your perspective. What are you seeing in the sale and purchase market today, and how are vessel values performing relative to how they have been the past few months?
Yeah, so I think, if you look at the latest data points, there's no doubt that we see a stronger focus, and we also see increasing prices for very modern ships. So like the 1 to 5 year old tonnage is definitely in demand and going up for all the reasons I kind of mentioned in the beginning. We're beginning to see now demand as well, even for the older vintage type ships, 10, 15 years old, again, reflecting a strong spot market. So, but I think what's super interesting actually in this situation is kind of the reverse world that we're looking at, because what you'd normally see when markets go up, spot markets go up, earnings go up, is of course that secondhand prices follow along. And as the market begins to have faith longer term, you'll see 1 year time charter rates, 2 year time charter rates start to go up as well, and that will support secondhand values in general. And at some point, people will jump to new builds because secondhand prices are too expensive, and we'll all go like, well, we'd rather have one in a year and a half time out there, 2 years out at a cheaper price. And then the cycle starts again, if you like. And today we're seeing the absolute reverse. I mean, when we look out at new builds, delivery is late 24 into 2025, prices are way, way, way above what the equivalent depreciated value is for a secondhand ship today. So we think there's a lot more to go actually on secondhand values, and I think you're going to see as markets continue to be strong going forward, that vessels will go up. The underlying values for tonnage will definitely increase, and I think we'll see a market where there'll be a fight, as I said earlier, for the modern tonnage, because basically replacement is still not an issue in terms of having a new build, because it just doesn't make any economical sense to go down that route. So that's kind of how we see that market at the moment.
Thanks, Mikael. Maybe just on the new build front, wanted to ask is just a follow up. What needs to change for new buildings to become more attractive for investment?
Well, I think it's a combination of a few things, right? So one is, of course, that just, it's become a lot more expensive purely from a cost perspective. So obviously prices have gone up on steel, etc. So that's the labor cost side. So that in itself has increased the base. So that's one part of it. I think the other part is that shipyards actually do prefer to build LNG, container ships, and other types of tonnage than product tankers. I mean, it's a better business for them going forward in general. And then the final point, but maybe the most important, is that everything you order now for delivery in 2025, for instance, will obviously last another 25 years. And I think the uncertainty of oil demand, when you look in that very long perspective, being replaced by renewables, of which the jury is still out, which will be the best alternative, I think is keeping everyone cautious, right? And you think, if I go to our board and recommend buying 10 new built product tankers of old design, I think they'll probably look at me and say, well, do you mind going through that business case and try to illustrate for us why you think that's such a great idea? So and I think this is in a way creating a super interesting supply side, which I think all of us here on this panel has been pointing at for a while, that this is, on a longer term perspective, is probably what's going to keep this market very strong in the next years to come.
Great. Thank you, Mikael. Tony, just to follow up to that, Mikael mentioned going to the board and presenting a case to buy a bunch of new buildings. What do you think? Typically in a rising market, a lot of ship owners want to go and buy the oldest tonnage, go out and buy 15-year-olds or 18-year-olds perhaps, to take advantage. Do you think that will continue if we continue to progress through an upcycle here in the tanker market? Do you think we'll see buyers coming in to buy 15-year-old ships plus and take advantage of that? Or is there a change where people are focusing more on the emissions and eco design and all the IMO regulations? How do you think that plays out this time?
It's complicated, right? Because on the one hand, we do have everything that Mikael just described in terms of the desirability of modern fuel efficient ships, and yet real resistance to ordering new buildings that are going to last a lot longer, and we don't really know what the right ship is to build just yet. On the other hand, if you look what happened in the container sector, if rates got high enough, all of a sudden it's the oldest ships that all of a sudden the cash flow value becomes so significant. So I think that you could see older tonnage values rising, maybe at a greater percent for that reason, if we really get into sustained strong rates. Having said that, in our business, when you get over 15 years of age, the tradability of a vessel, in products anyway, and crude becomes quite restricted. So it's there are competing forces at play there. I do think it's worth observing that, let's say if you go back 6 or 7 months ago to today, we have seen secondhand values of modern ships. Now, there's not a lot of trading activity, but there are data points. And the older, kind of sort of, 12, 13, 15-year-old ships, they've probably all gone up by 15 or 20%. And that's not insignificant. I don't think that's reflected in the, research analyst NAVs, for example. So, I think there's something happening. I think it's underpinned by the very strong across the board demand for shipyard capacity that we're seeing from other sectors, driving new building prices up. Even in spite of the fact that from a technical standpoint, it's not a very desirable move to make, and it's hard to justify at the moment. So I think there are, some interesting movements, taking place already. But, we're, again, I want to preface by saying for all the wrong reasons, I don't think anybody's happy with what's turbocharged this market, but, we're just a few weeks into a much different market. And if I could just go back to our earnings call and we were talking about the fact that, the fundamentals were strong. This was, a little more than a month ago. Fundamentals were very strong and trending up, but the oil market dynamics were, like optimally negative for the tanker market broadly. Just in time, type of buying activity, everything settled into, very, very, very controlled, trading patterns, backwardation, really limiting voyage lengths, etc. And we're in a completely different world now. So anyway, I'll stop.
Oh, thanks, Tony. Jacob, just on the point of investing and looking to acquire ships, does it make sense, you think, as a public company? Can you justify ordering, or sorry, not ordering? Can you justify acquiring non-eco ships to take advantage of a strong market? Is that something that we can expect public companies to do, or are the stakeholders really focusing on eco? And so, if you are to acquire a vessel, it needs to have that eco stamp. How do you think about that?
Personally, I would be relatively surprised if you see this panel going and being the buyers of the 15 to 18-year-old tonnage. But of course, you can never say never. But I think there's a choice here where you can actually have a longer view as a public company around what it is that you're doing and trying to achieve, as we also discussed earlier in this debate. So I would say no, but of course, if rates are through the roof and you can box it in to some kind of model with a customer, it may happen. But I think we are predominantly going to be more supplying tonnage of that vintage from this panel, and that there will be, I agree with that, there will be a higher interest also into that particular type of vessel as we move forward. And I think the whole theme around this is that as the market now has demonstrated what strength it has, as that goes on for longer, normally you would see exactly what Mikael described, is that ship owners would sort of fall into the trap of saying, oh, well, I got all this cash, it's probably better that I reinvest it into a new vessel because it's cheaper. It's very difficult also to see that is happening. So you will have from this sector, I think, a lot of profitability that can be rewarded back to the shareholders rather than to management's ambitions about growing a company.
Thanks, Jacob. Well said. I want to ask one final one before we do a concluding round of comments. But James, this one's to you. Are we getting any closer to a fuel of the future in the product space?
It's hard to say. We put out an announcement yesterday about a partnership to evaluate carbon capture on vessels. This is more of an intermediate solution, similar to the scrubber investment. We never saw that as a long-term solution, but a short-term. Right now, no, we don't really have a view on that. There seems to be several possibilities, but the further we get, I think we'll have a better idea. The challenge, in my view, is infrastructure associated with the new fuel. Specifically, it might be easy to put bunker infrastructure in for a container vessel that's calling the same ports throughout the year. But if you're trading an MR in Latin America or West Africa, how do you think about the infrastructure associated with the new fuel? So for us, no view as of now. And also the cost to determine that is quite expensive. For example, if you were to do it on a new build, which we have no plans to do, but that's kind of our thought process there. So we'll see. I know Tony and his team have looked at hydrogen, which seems quite interesting. It's going to be an interesting process.
Yeah. Thanks, James.
On that, if I can, I would like to chip into that one, because Maybe what we are going to be seeing, which we already have some promising signs, are some transition solutions that are not going to eliminate completely CO2 emissions, but are going to help us reduce them quite a bit. And as Mikael, we have been testing biofuels on our vessels with 30% components from renewable sources. And we have achieved very good results in terms of in reduction in emissions of CO2, performance of the engine, and nitrogen oxygen emissions, which stayed within the limits. And we are going to be testing going forward also blends which have a higher component of biofuels, 40% and 50% this year. And hopefully we are going to be able to achieve some good results there.
Great. Yeah, well, looking forward to seeing that, Carlos. Great. So I think I would like to start to wind down the panel discussion, but I think it's good, I think, to go around the panelists again, and if each could just give, how are they viewing the use of capital or use of, say, free cash that's being generated? How do you view that evolving here over the next year for each company? Tony, could you kick that off first again?
Yeah, I mean, we've had a consistent capital allocation policy for the last 3 years. We want to reduce our debt down substantially. That'll then actually generate more free cash flow for eventual distribution. But I will say that if our stock price remains at these kind of levels in a strong market, I think we might do something else.
Thanks, Tony. James, for Scorpio?
Not ordering new vessels, so we won't be exploring any of the new propulsion systems as of now. Look, today and a year from now, I think we're looking to improve the quality of the investment. We've had a really challenging 6 quarters, everybody on this panel, some of the most challenging in our company's history, and we didn't raise equity in the difficult times. We increased our leverage. And so I think going forward, our focus will be debt repayment and returning capital to shareholders.
Thanks, James. Carlos, for DOMICO.
Yeah, we have been focused on strengthening our balance sheet, and that will continue being our focus in the near term. Also by exercising some of the purchase options we have on the vessels we bareboat in. So we have 8 of those that we can exercise still. 7 we can exercise right now if we want to, and they're all in the money or theoretically in the money. So that will be our first priority, to continue reducing our break-even, making the company even more competitive. And after that, it will be potentially also share buybacks. We have an authorization to buy back up to 15% of our issued shares. We currently have bought back only 1.5%, so there's a lot of room there to do more, and then distribute cash to shareholders.
Thank you. Mikael, for Hafnia.
Yeah, so as I explained in the beginning, we've been through quite a bit of an acquisition period, adding these 44 ships to our fleet. So part of that actually came with high leverage. So our focus will be, we've done our growth strategy. We want to refinance, reduce part of our leverage a bit. But otherwise, the focus is really on returning capital to shareholders in forms of either dividends or share buybacks. So the growth area is kind of been completed. So now it's really about trying to harvest from the scale that we have built up before this peak in the market.
Great. And Jacob, for TORM.
Yeah, so we've also been, over the past couple of years, been growing our fleet without really raising our leverage. So we're ready to enjoy the strong markets and to pay back and distribute to shareholders as the priority 1, and then simply maintain our fleet.
Great. So it sounds we're all in line to start benefiting from this, and everyone's going to start harvesting cash and returning it to shareholders. It's a fantastic and rewarding opportunity for investors. Well, good. Well, I think this is. Nicholas, I think we've reached the conclusion of this panel. So I thank you.
Well, thank you very much, and you finished right on time. I have to say this has been one of the best attended panels, and clearly the topic is top. but also our moderator and panelists are top. So no wonder. Thank you very, very much to all of you. I really appreciate it. I have to say that these 2 days have been particularly interesting, given the content that we have been delivering. And thank you to all the leaders for being on board and making it happen. And Omar, thanks for the great moderation.
Thank you, Nicholas.
Thank you.
Thanks, everyone.
Thanks, Nicholas.
Thank you.
Thank you.
Bye-bye.